Stocks aren't just investments, they're the gateway to wealth, freedom, and power. If you want to be rich, you must understand this. Stocks are pieces of ownership in a company, but more than that, they are a doorway into how wealth is created in the modern world. When you buy a share, you're not just purchasing a digital number on a screen, you're buying a fraction of a living business that employs people, sells products, generates revenue, and makes decisions every single day. This tiny slice of ownership grants you the right to benefit from the company's growth, its profits, and its increasing value over time. That's why people say stocks represent equity, they give you a claim on everything the company builds. Most people grow up believing money is made only by working, but the wealthy know that ownership is the real engine of financial power. Stocks give ordinary people the chance to access that world of ownership without needing millions in capital. If a company becomes more valuable, your shares automatically grow with it. If it earns profits and decides to distribute them, you receive dividends. Stocks turn the idea of money making money into a tangible, accessible reality. In simple terms, stocks are the tool that transforms regular people into investors and investors into wealth builders. Understanding them is not optional, it's essential. Companies sell stocks because they need capital to grow, expand, innovate, and stay competitive in a fast-changing world. Imagine a business that wants to build new factories, hire more employees, create better technology, or enter new markets. All of that requires money, often much more than the company has on hand. Instead of taking out massive loans with punishing interest rates, companies can raise this money by offering shares of ownership to the public. When a company goes public, it basically says, "We're opening the door. Anyone can become part of our growth story." Investors buy shares, the company receives cash, and in exchange, those investors get equity. This relationship works because both sides benefit. The company gets the fuel it needs to climb higher, while investors get the opportunity to profit from the company's success. Selling stocks also increases a company's credibility. Public companies must report their financials regularly, follow strict rules, and operate transparently. This builds trust with banks, regulators, and the global market. Stocks make it easier for companies to raise future capital, attract big investors, and become long-term giants. In short, companies sell stocks because it's the most powerful way to multiply their resources and create wealth for those bold enough to buy in. Imagine you open a small sneaker shop. Business is good, but you dream of turning it into the biggest store in the city. You want better inventory, more employees, a larger location, and maybe even an online store. There's just one problem: you don't have enough money to grow. Instead of taking loans, you sell 40% of your business by creating 40,000 shares. Each share represents one tiny piece of your shop. People who believe in your vision start buying those shares. With that money, you upgrade your store, advertise aggressively, and launch your online platform. Sales explode. Suddenly your shop is worth much more than before. Now imagine someone bought 1,000 shares when each was cheap. As your business grows, the value of those shares skyrockets. The investors didn't do any of the daily work, yet they profit simply because they believed in your growth. This is the core idea of the stock market. Investors support businesses with capital, and in return, they share the rewards. It's a partnership built on trust, risk, and ambition. And just like your sneaker shop, the world's biggest companies, Apple, Tesla, Amazon, once needed investors who believed in their potential. Stocks turn dreams into expansions and expansions into wealth. Investors make money in two powerful ways: capital appreciation and dividends. Capital appreciation happens when the value of a stock increases. If you buy a share for $10 and the company thrives, pushing the share price to $20, you've doubled your money. This growth happens because the market believes the company is more valuable. It may have better earnings, stronger leadership, new products, or growing popularity. Wealth in the stock market is built when you ride this wave of rising value. The second way is dividends, cash payments directly from the company's profits. Not all companies pay dividends, but those that do reward their shareholders for sticking with them. Over years, dividends can become a steady stream of passive income, sometimes even larger than the initial investment. Long-term investors combine both strategies. They choose companies with strong potential and hold their shares for years, allowing compounding to work its magic. Compounding is when your earnings generate more earnings. It is the silent force behind most great fortunes. Investing isn't about luck or timing, it's about patience, discipline, and choosing businesses with real growth potential. When you understand this, you realize that investors don't get rich quick. They get rich steadily. People buy stocks through online brokerages, platforms that connect regular investors to the global financial markets. These apps and websites allow you to buy shares with just a few clicks, making the process easier than ever. Decades ago, you needed a human broker, tons of paperwork, and high fees. Today, trading platforms are accessible, fast, and often free. When you create an account, verify your identity, and deposit money, you gain access to thousands of companies across different countries. You can buy a single share, multiple shares, or even fractional shares, which let you invest with very small amounts. Brokerages also provide charts, research tools, and news updates to help you make informed decisions. Behind the scenes, all trades take place in major stock exchanges like the New York Stock Exchange or NASDAQ. These exchanges act like giant marketplaces where buyers and sellers agree on prices. Modern technology ensures everything happens instantly. Buying stocks today is so accessible that the real challenge isn't access, it's education. The tools exist for anyone to participate, but only those who understand how stocks work can use these tools to build wealth instead of gambling blindly. There are two major types of stocks: common stocks and preferred stocks. Common stocks are what most people buy. They give you ownership, voting rights, and the chance to benefit from price growth. They can be more volatile, but they also offer the highest potential returns. When people talk about investing to build wealth, they usually mean buying common stocks in strong companies that can grow over time. Preferred stocks are different. They behave more like a hybrid between a stock and a bond. Preferred shareholders usually don't get voting rights, but they receive fixed dividends and are paid before common shareholders if the company faces financial trouble. They offer stability but less explosive growth. The choice between the two depends on your goals. If you want long-term growth, common stocks are the path. If you want predictable income, preferred stocks can be appealing. Understanding these categories is crucial because the type of stock you choose shapes the level of risk and reward you're taking on as an investor. In the end, both exist to align with different investor profiles. Wealthy investors often combine both types to balance stability and upside potential, creating a strategic, diversified portfolio. People invest in stocks because no other asset has consistently created more wealth over long periods. While savings accounts protect money, they don't grow it. Inflation silently eats away their value year after year. Stocks, however, give you a chance to outpace inflation and increase your purchasing power. Historically, stock markets rise over time because businesses expand, innovate, and generate profits. Investing in stocks also gives you access to compounding, the strongest financial force available to everyday people. When your investments generate returns, and those returns generate more returns, your wealth accelerates exponentially. This is how ordinary investors become millionaires after years of disciplined investing. Stocks also provide freedom. They allow you to build a future where your money works for you, not the other way around. Whether your goal is retirement, financial independence, or simply living without constant financial stress, stocks create options. The wealthy invest because they know ownership is power. When you invest in stocks, you stop being just a consumer and start being a co-owner of the world's most successful companies. That shift in mindset changes everything. Stocks are not magic, gambling, or guesswork, they are tools for building real and lasting wealth. If you understand how they work, respect the risks, and stay consistent, they can transform your financial world. The difference between those who stay poor and those who grow wealthy often comes down to knowledge and discipline. Investors don't rely on luck, they rely on strategy, patience, and the ability to see opportunity where others see uncertainty. The stock market rewards those who educate themselves, think long-term, and stay calm during volatility. It punishes those who panic, chase quick wins, or invest blindly. Your financial future depends on which side you choose. If you want to be rich, truly rich, start by understanding ownership. Stocks are the easiest and most accessible way to claim your stake in the world's greatest companies. The sooner you begin, the sooner compounding starts working for you. Wealth isn't built in days, it's built through consistent decisions that align with your goals. Your journey starts the moment you decide to invest with purpose, clarity, and courage.